The 10-year US Treasury yield, a benchmark for long-term rates, has been on an uptrend this year. It started the year at 0.93%, jumped 61 basis points to a high of 1.54% on February the 25th, and has been pushing higher since. Yields on longer-dated peers, the 20 and 30-year bonds, have been on a similar move up. So what is driving yields higher? A combination of rising inflation expectations, improving growth prospects, and a $1.9 trillion fiscal stimulus package.
Inflation expectations have been rising rapidly on the back of signs of economic recovery and also vaccine rollout. Second, fiscal stimulus. It is affecting the market in two ways, but in the same direction. It is adding to economic recovery and also inflation, so that feedback onto the first points about inflation expectations. B, any fiscal spending needs to be financed, so that would only means that it would add to bond supply, so naturally yields are going higher.
For now, market watchers are not too bothered by the run-up in the yields.
So I'd say that if the rates gradually rise, it's not necessarily a bad thing. It's a reflection that the market can accept a higher rate. The main thing we are hoping for is stability in the rates and stability in the management of the views in the market.
Some key central banker has already put it, like if the increases in yields reflect expectations for economic improvement, reflect some pickup in inflation, that should be seen as healthy. However, they might be a bit concerned if there is disorderly movement in the market.
10-year Treasury yields will need to breach the neutral rate of 2.5% before the US Federal Reserve will become concerned. Based on the Fed's most recent dot plot, 2.5% is the longer-run neutral rate, at which monetary policy is neither accommodative nor restrictive and keeps the economy at full employment with inflation around 2%. But inflation could turn ugly and cause yields to spike higher.
The issue here is more of a cost side, cost push inflation, which is commodity prices going up, your factors of production goes up. People's real income could actually be less because their incomes are actually not compensating for the rising cost of goods and how much they have to spend. The market is kind of looking a bit further ahead and saying that no, the Fed probably will, or central banks will have to start tightening liquidity possibly earlier than what they are saying. Because if inflation pressures come out higher than what they expect, they might have to act faster.
Risk assets are vulnerable to this spike in yields. Investors have been piling into risk assets, equities and bonds alike, as they search for yield in a financial system that's awash with liquidity.
Because of this very low interest rate environment since 2009, the search for yield keep on increases, and most recently last year because of central banks suddenly say, hey, due to the pandemic, we are not going to normalize interest rate for a long period of time again. So that actually increased more demand into assets that hopefully get a better yield than bank deposit, which is one of the places definitely will be equities.
Rising yields could see them move their money out quickly. This has brought back memories of the taper tantrum of 2013. Back then, the Fed announced that it would taper its quantitative easing, or QE program, where it bought bonds and cut interest rates to help the US economy recover from the global financial crisis. US 10-year yields jumped 140 basis points to nearly 3% at that time. And money flowed out of emerging markets.
Any tantrum won't be driven by the central bank. Any tantrum the origins today will be market-driven because the markets are moving the market, moving the bond yields, right, in the longer end.
The Fed has tools at its disposal to keep yields in check.
Operation Twist basically is the Fed, selling short-term, issuing short-term bonds, and using the money to buy long-term bonds. So, for example, selling short and buying the 10-year or the 30-year. And by providing buying support in the longer end of the bond curves, they actually kind of prevent the yields from jumping too high, right?
And even if there is another version of taper tantrum, Asian economies are better placed to cope this time round.
A lot of lessons have been learned since the bad experience after the Asian financial crisis, and Asian governments have been very prudent in their gearing. Quite a fair bit of the bond issuance have been in local currencies, so they avoid the FX exposures that was experienced pre Asian financial crisis in '98. So that's one buffer. The second buffer is also that we feel that the issuance of debt has been really more prudent and more careful, leading to, of course, a lower supply of bonds in the market than investors would like.
We don't believe that there would be a taper tantrum. Okay. Asian markets will not be immune to the global yield movement, but I think we shall appreciate that over the past few years, a lot of the Asian central banks and governments have gained credibility on various fronts, and that include fiscal disciplines, monetary policy, and liquidity management. And numerous Asian central banks would also have ammunition, if needed, to absorb some volatility in the market, not least because they have been less dovish than most of the other major central banks.